Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Marko from OptionSlam. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So, Mark, I'm going to stop sharing and pass the ball back over to you.
Okay, will I need to do any button clicking to
yeah, you should see on the Quick Start tab, share my screen, or on the Share menu, you can do it.
Yeah, okay, and then share my screen. There we go.
Yep, it's coming up. All right, I see CFTC Rule 4-4.41.
There you go. Okay, well, thanks again for having me on, Tom. And
yeah, we're happy to have you.
Great. I'll try to get through and right to some content here. I appreciate the disclaimer. So there is my ugly mug, and my name is Mark Letterman. I'm also known as Marko, mainly in the trading world. And welcome everyone to the introductory lesson on the Double Eagle Trading Plan. So I'll be your host today. Just please bear with me while I tell you just a little bit about myself. I am retired from a career as a builder. I specialize in building and remodeling high-end homes, as well as taking on some light commercial work. I've been trading for a very long time. My first stock was given to me when I was about 14 years old from my father as a birthday gift, as he tried to introduce me to the world of investing. And I've pretty much been hooked ever since. And I'll spare you the details. Because I have so much stuff I want to cover with you today. And I just know that we have limited time. And but let me scan through my notes here, and I'll spare you the story about my first stock and my love of boats and marinas and the rest. But I've done the gamut of trading, from day trading stocks and futures, and eventually I found my comfort zone in options. So I do not have any formal education in investing. More so, I've learned from the School of Hard Knocks. So I'm sure many of you have learned lessons the hard way, and sometimes that's a good way to learn some lessons. It sticks with you.
Yeah, I had a math teacher in 8th grade who said the only test questions you remember are the ones you got wrong.
There you go. Let's see. So I'll bypass the rest of this. I am a principal owner at OptionSlam.com, and that keeps me really busy. Between trading my own account and managing the OptionSlam.com website, I'm a pretty busy guy. Over at OptionSlam, we offer a lot of tools for traders. Both retail and professional traders use us from all around the globe. We cover about 6,000 stocks, and we have a special focus on earnings events. And today's webinar is about trading earnings events, or at least trading options strategies based on the anticipation of upcoming earnings events in the near future. So that's my email address on the screen. If you have any questions after the webinar, please feel free to reach out to me at optionslam.com at gmail.com. Pretty easy to remember, optionslam.com at gmail.com. So today's discussion is about the strategy that I've given the name Double Eagle, because you know, we used to call it the LVDC, and eventually I realized that, you know what, everybody's got names for their strategies. LVDC stood for Long Volatility Double Calendar, and you know, we've got, you know, butterflies and iron condors and all kinds of other flying animals that we name our strategies after, and I thought this strategy is so powerful it needs a powerful name. So hence, again, I'll spare you the details of exactly how I came to that name, but it has to do with you know, how the eagle positions himself, waits for his prey, and when the opportunity arises, pounces and takes advantage of opportunities to not only enter into the hunt, but reap the rewards afterwards. So we'll get past. So this may start out just a little bit dry for you seasoned traders. I'll, as I've done already, I'll skip through some of the fluff and the basics, but please bear with me through the first few slides, because we need to make sure that any newer traders, you know, at least have the basic concepts. I'll just try to touch on those and then get right into the material and the discussion of today. I neglected to get myself a drink of water, so if you'll bear with me for 30 seconds, Tom, I'm going to get myself a glass, because otherwise I will just dry up.
No problem.
Most of our audience is well-seasoned traders, and you guys don't need you don't need me to tell you what a call is or what a put is or what you can do with them. But as we know, that's all there is to options. It's really pretty simple. There's only calls and puts. There's only two things you can do with them. You can buy them and you can sell them. So yeah, it's more complicated than that, but really, if you think about it, that's what it really dials down to. So a calendar spread involves, and this particular strategy involves all of those things. It involves calls and puts, and it involves buying them and selling them. So it's not complicated. However, it does get a little bit involved, and there are nuances that need to be taken into consideration when entering into the double eagle. Calendar, by definition, refers to an option spread strategy involving options of the same underlying equity, same strikes, but different expiration cycles. Calendar spreads can be either all calls or all puts. Of course, there's variations, diagonals, etc., but we won't get into that today. Okay, again, more definition. Generally, calendars are put on as a debit trade, selling the shorter dated option. Okay, so we're dealing with two different expiration cycles, a shorter dated option, and then we buy the longer dated. So we sell the shorter dated option generally, and we buy the longer dated option. We sell the July and buy the August, for example. One of the ideas behind the calendar spread is to sell time, which is one of the reasons calendar spreads are also known as time spreads. Another reason for the name time spread is that the contracts are spread out horizontally over time. In my last example, I said, for example, you sell the July and buy the August. The trader hopes that price of the underlying moves to, but not beyond, the near month option strike, so that they expire worthless or near worthless. This is where max profit is made. As the time decay of the near month option is at a faster rate than the longer term options, the trader's long-term options still retain much of their value as the fronts or the short options are expiring. We've all seen representations of the theta curve, and this is just a simple diagram to illustrate that as an option approaches its expiration day here at 0, it's always losing value due to time decay, or theta. And the closer you get to the expiration day of an option, the faster that curve becomes, and the steeper it becomes, and the quicker it loses its remaining value, specifically extrinsic value. So if we sell shorter dated options, they reach their expiration day sooner than our longer dated options, which are in a less steep part of that theta curve. So let's get right to it and build a calendar spread. I'm going to go and use the Thinkorswim software, if you don't mind.
Yeah, I'd say the majority of folks use Thinkorswim in our community, so that's fine.
Awesome. And here's IBM. And this stock happens to be just perfectly right. The timing is right, in our opinion, and in our research. We've found the right time to put this trade on for most stocks, generally speaking, as well as we've kind of dialed in and are continuing to dial in on when's the best time to put the strategy on a stock-by-stock basis. But our research continues. So if you don't mind, I'll use the Analyze tab, because I love the graphical illustration of where your profit and loss risk graph looks like once you design a strategy. And quite simply, we've got an earnings event coming up here on IBM. Let me just take a quick peek here and make sure. Let's see, IBM. Okay, so I got IBM coming up on OptionSlam.com, and if you use OptionSlam.com, you'll see that there's an earnings date for IBM scheduled for July 18th. Okay, and if this is an estimated date, it will use some language up here saying estimated, or it'll use the word estimated in some fashion, or some version of the word estimated. If you don't see the word estimated, this means we've confirmed the date. Okay, so this date is confirmed, and we do put this strategy on stocks with confirmed dates, and we put this strategy on stocks with estimated dates. And I'll get into the reason why we will put the strategy on ahead of knowing the date. There's some benefits to actually putting the strategy on ahead of the press release from the company. Okay, so July 18th is the date, and so what we'll do is let's go ahead and look at July 18th is going to be right here is the expiration. July 21st, which is the regular monthlies, is the expiration that happens after the earnings event. July 14th is the expiration that happens prior to the earnings event. And taking a look at the options chain here, you can see that there's a relative jump in implied volatility that happens right at that point. In other words, take a look. We're at 31. Go ahead, Tom. I'm sorry.
Oh, do you have United Airlines loaded instead of IBM?
I do. Thank you for bringing that up. I don't know how that happened, because I thought I had punched IBM in there, but apparently not. Thanks for catching that for me. So
yeah, thanks, Gary.
I do that often, so keep a close eye, because I get ahead of myself. Yeah. So here's another another case of let's see, July 18th. So the 21st again. So from that last screen, that just indicates to me that UAL also must be reporting in that same week, because you saw the implied volatility jump from 30 to 33 in UAL. And here you see it happening in IBM. with 16, 16, 15, 15, and then a big jump up to 19 that happens, and this is obviously due to the anticipation of that earnings event happening there. So let's build a quick calendar using those 2 weeks. The week prior to the earnings event, the options that expire prior to the earnings event, and the options that expire post-earnings, okay? And quickly, we'll just do let's see, the stock is trading at 154, so 155 is going to be the closest strike there. Let's take a look at delta neutral, or almost neutral, at the money. I usually pick on call calendars a lot for illustration purposes, although I like put calendars for some other reasons. But call calendars are in a lot of stocks are easier to fill because there just seems to be more volume, generally speaking, in calls than there are in puts. Not always the case, but like I said, generally speaking. So you can see that the fronts in this particular case are trading for 214 by 233. And the backs, what we call the backs, or the long contracts, are trading for 325 by 340. So if you sell the fronts for, let's assume, a mid-price somewhere between 214 and 233, and buy the longs simultaneously, which is what is modeled up down here, buying the longs into the July 21st expiration cycle, selling the shorts in the July 14th expiration cycle, the net debit, and these trades are always a debit, the net debit is only $1.07, and this is all you have at risk. Calendar spreads are defined risk. You can't lose any more than that. But when you model it up in a risk graph, you look at that and you go, you know what, Marko? You can have that trade because I'm not interested. The window for profit is so narrow, and the maximum profit is so low compared to the amount of money that I'm risking. Yeah, thanks, but no thanks, right? Wouldn't that be your first reaction when you saw a risk graph like that? But I'm here to tell you folks, and I'm here to prove to you, and I'm here to illustrate why this is a great trade, and more often than not, very profitable. And it's simply because there's two things that happen in a calendar trade, especially designed like this one. Theta comes out of your front shorts, and IV never goes into them. Theta, yes, it comes out of my back longs too, but I have implied volatility will come to the rescue in this trade for me by pumping up the extrinsic premium as we get closer and closer to that earnings date. Implied volatility will help offset the theta decay, and this risk graph will only grow. The break-evens will get wider as we get closer. Now, that's assuming all other things remain constant. For example, all other things, yeah, if price stays close to this zone, this trade obviously will become a positive winning trade. However, if price moves far away from the 155 strike, yeah, then that's where the trade gets in trouble. So, you know, let's do this quick. I'm going to try to do this real quick. Let's take a look at when was the last earnings event? April 18th, okay? So if we go to April 18th, let's just dial in on, let's use think back here, IBM. Let's go back to, there's April 18th. Let's go about, I don't know, 5 or 6 weeks before that. Which is about the same timing as we are now ahead of IBM's next earnings event. And let's just take a look at, let's see, April 18th. So it would have been the April 21st, would have been the week that expired after the earnings event. You can see again, going back in time using the think back function of thinkorswim, you can see again at about 5-6 weeks ahead of the earnings, the jump in volatility was apparent. Okay, from 16s, and then all of a sudden, almost to 20. So here's what we need to do now. Let's take a look and see how much did implied volatility, how did it change as we went forward in time? I'm not going to go day by day. In the interest of saving time, I'll go 1 week at a time. So let's just make a note. I will on a little piece of scrap paper. We're at 16. Let's just call it 16 and 20. 16 and 20. The fronts are at 16. The backs are at 20. Go forward a week. We're at 17 and 19. So, oh, wait a minute, I'm wrong. We're at 14 and 17. So the fronts went down a point or 2 points, and the backs went down a couple points there. So this is making a liar out of me. Let's go forward another week. And then we're at, fronts are at 15, and we're back to our almost 20 so we're at 15 and 20 now. 15 and 19, whatever. Okay, and then we'll go forward another week. We're getting into the first week of April now. And the fronts are now losing implied volatility. Not only are they deteriorating due to time decay, but they're losing option premium, extrinsic premium due to the Vega factor. They're losing implied volatility related to the Vega factor. Longs kind of just holding their own, not much above where we started at the 19.8, but they're up just a little bit above 20 now. Let's go one more week. And this is now we're into the front week where the front options are expiring. This is the last week of the options. This is the Monday. The fronts are expiring. They started out at 16. They've deteriorated down to 15. Our longs started out at 19.8. They just all of a sudden gained a bunch of points to 25.3. And let's move into the end of that week, the 13th, which is the fronts expiring, and the longs by this point have gained up to 27.78. So thanks for putting up with me through that little exercise. But now we've got a handle that we know about how much implied volatility, just in this one instance, increased in that 5 or 6 week period from the time we hypothetically put on the trade to when the fronts expired. And it was about 8 points, was it not? Are you with me on this so far? So now we'll go back to our model here, the little trade that we put on, and let's model up some increased implied volatility. I won't even bother with the decrease of implied volatility in the fronts, because by the end of the expiration week that those expire, they will lose all of their implied volatility. All IV is gone by the end of the day, Friday, expiration day. The only thing that matters at the end of the day is how much intrinsic value is left, if any, in those options. So let's, what was that number again? Let's go back, think back. It was, okay, it was from 19.8 to 27.8. So that would be 8 points, right? Go back here and let's see what happens when we simply add 8 points of implied volatility to this risk graph, and you can see that the expiration risk graph changes completely, and the one-day risk graph has a dramatic change. To be fair, let's move that up to the fronts expiring, which would be right in here. There you go. So as the fronts are expiring, that is what you might expect the risk graph to look like if we get an implied volatility build going into this next earnings event, similar to the implied volatility build that we got in the most recent earnings event. Now, this happens to happen much more dramatically on many other stocks. The FANG stocks, for example, which we trade. We've dialed this down to really a science. We've done extensive testing on many, many, many stocks. And we've dialed this down, and we know what stocks this strategy works on, and which ones it doesn't. Now, the problem with this risk graph is what? Anybody want to chime in? What? Yeah, Marco, that's great. The risk graph looks better than it did when you first presented it, and implied volatility, you've proven to me that. But there's still something inherently wrong here, and that is that it's just not wide enough to sit here. I don't really think that IBM is going to sit here in this zone for us to be able to realize profit. It's just too narrow of a tent, if you will. Let's take a look at what is one standard deviation, for example, out to the fronts expiring. No, that didn't work, did it? Fronts expire here, and I got that set at 68. Well, this isn't cooperating with me. I don't think that's an accurate one standard deviation out to July 13th. So I'll just carry on from here. So the point that I'm trying to make here is that this is just too narrow. So what could you do to widen this risk graph, okay? And that is simply done let's see. That's simply done by taking a look at, I wanted to see what one standard deviation was, but I can tell basically it's going to be about the implied move out to the fronts here. Am I still coming through good, Tom?
Yes, you are.
Okay, great. All right, so it looks to be about a $5 implied move. So if we just take that 155, and rather than doing the 155 call calendar, let's go up one standard deviation approximately to the 160 call calendar. And of course, when you get further out of the money, the calendars become less expensive. At the money calendars are going to be the most expensive. Out of the money calendars, somewhat less expensive. If we take a look at that out of the money call calendar, now for us to be profitable, we need stock to move up into what we call the tent pole in many cases, or the tent zone, or the tent pole, I guess, and the of the calendar spread, which is at, this is where calendars make the most money, obviously, is at the strike spread, the strike in which you put the calendar on. And then if we do the same to the downside and employ a put calendar, also about $5 or approximately one standard deviation away, and we buy another calendar, same expiration cycles, one standard deviation away, 150 now, using puts. I always like to use out of the money strikes, out of the money to create my calendars. And now you say, well, there's another problem. What happens to the risk graph when you put on a double calendar is you get this sag in the middle in which you can still experience loss. However, we've widened our winning zone out to all the way out to 148 approximately, theoretically, given the parameters that I've input into the more parameters tools here, all the way down to 148 approximately, all the way up to 161. Yeah, and it's showing somewhat of a sag in the middle, and this is the today line on 7/13, about a day ahead of the fronts expiring. And as you can see, even if the price comes back to the center zone, you will be, and of course this is hypothetical and theoretical. If I pumped in more volatility, this would look better. If I pumped in less volatility, this would look worse. But the reality, the proof is in the pudding. The proof is in the historical putting on of these trades, and we have tons of research that we've done over the years of not only back testing these trades, but actually putting these trades on live quarter after quarter after quarter. It doesn't work on all stocks, okay? But we've done a lot of research, and we've dialed in on which stocks it works on, which stocks it works best on, which ones it doesn't. So let's get back now. Any questions so far? I could take a couple questions if anyone's got any general questions on the approach here.
No questions yet.
Okay. Then we'll see if we can get back to that PowerPoint to try to get me back on track. And, okay. All right, okay, so back to the PowerPoint, and then we'll get into some of the research and other examples that I'd like to share with you all. Let's see, how do we make money with calendars? The front shorts decay at a faster rate than our back longs, and implied volatility increases in our back expiration contracts to help offset the theta decay. So another thing that we have over at OptionSlam.com is a back testing tool that is in beta. We are building it. Let me just quickly show it to you. Okay, so let's see. Here's OptionSlam.com. And if you go to OptionSlam.com, if you are an insider member at OptionSlam.com, in other words, a paying member, you can use this tool at no additional cost. Currently, while it's in development, we're offering it for free to our insider members. It's here with the acronym OSBT, standing for OptionSlam Backtesting Tool. It's really simple and easy to use, and all you do is you put a symbol in there and a date here. Let's see, if I do IBM, and let's see, what was that date? IBM was April 18th, 2017. Let's just backtest it. I don't know if this was, let's just do it quick. It'll only take a moment. Let's see, IBM, April 18th. Okay, IBM, let's go to 04/18/2017. And then we're going to want to go, that was the earnings date, so we're going to want to go some time ahead of that. So let's go back into March. Let's go about the 13th, put us about the same time frame we are ahead of the next earnings event, okay? And then we hit the next button. We select one of the combos. We aren't done building all the different combos, but we do have a double calendar spread built. We're going to be a long calendar. We're going to sell the 13s, April 13s, and we're going to buy the 21s, right? Stock was trading for about 176. So one standard deviation, another way to determine what one standard deviation is to look at the price of the at-the-money straddle. So if the stock is trading for 176, we can go in here and just say, okay, what's the closest strike to 176? The 175. So the at-the-money straddle was trading for about $6.50, okay? The mid price between the 390, this is the bid-ask spread on the calls. Here's the bid-ask on the puts, okay? So 176, I'm going to do that one more time. We're going to go to the 175, 4, 6, about $6.50. So we'll close that out. And so what we're going to want to do is choose our strikes. Let's go for calls about $6 above the 176. 176, that's going to take me to about to the 180s, the closest strike I got because of the monthly. Sometimes you run into that problem with if you've got a monthly involved, you don't have quite as many strikes available. But we've got we've worked out how to work around some of the nuances like that. But just to keep it simple, let's do the 170, 180, and there's our trade. Simply execute the trade, and through the OSBT, you get an immediate report of how that trade performed with a profit and loss day by day report that populates right here. Okay, and as you can see, that trade started out very first day. You had a profit of $11. If you didn't take that profit, you were down $7, and it meandered around underwater a little bit. This is just a simple P&L report, and it's kind of flat above water and underwater. And I didn't know how this was going to turn out before I put it on. This could have very well turned into be a losing trade. But as you see, as you approach that front expiring, as long as the stock stays in between your strikes, or even if it goes slightly outside of your strikes, you're quite wide here. You got a $10 window plus some, right? You've got a $10 window to your temp poles, but your actual P&L graph is much wider than that. It goes below 170 and above 180. And as you can see, as you approach the fronts expiring, this thing starts to gain some momentum in the P&L up to $68 and $73. And if you were greedy and you didn't want to take, oh, wait a minute, I got to be careful not to go beyond the front expiration. The front expiration was 413s. So this trade is designed to be opened weeks before the earnings and closed no later than the front expiration. So here's the 13th. So sure enough, final day, fronts expired worthless, or almost worthless. You had to buy that 170 back for about $37, right? But you also were able to sell your long on the put side. Now the call calendar was pretty much a loser in this case, but the put calendar made up enough money in profit to net you out with a $73 return on only a $191 investment. Simple math tells me that is 73 divided into 190 is a 38% profit in about 5 short weeks. So there is a live example of how you backtest. Now, the other thing you can do with the OSBT tool is download that information to Excel. You simply click that button and find a place on your hard drive and save it and catalog that information, which we have done extensively. So, some of the questions I get about the double eagle. Marko, I was taught to never trade when earnings is coming up. Well, you know, the earnings is why this trade works. Yeah, it looks terrible in risk graph form when you first initiate the trade. They all do when you're doing the double eagle. They all look terrible. You have to ignore the risk graph and have faith in the strategy. Have faith that implied volatility will come to your rescue. Time decay will work in your favor. I was taught to never trade when earnings is coming up, you know, and I was taught to sell high IV and buy low IV. You're doing the exact opposite, Marko. You're selling the lower IV and buying the higher IV. Well, you know, that's correct. We are breaking that rule. We're breaking more than just that rule, but that's the main rule we're breaking. But given the laws of earnings, we sell the lower IV knowing it's going to go lower. It's not, we're selling options that expire prior to the earnings event. That IV is heading south. It's not going to build as we approach the earnings event, just simply because those options expire prior to the earnings event. And we're buying high IV. I know, I agree, but we know it's going to go higher. So it doesn't look pretty on the risk graph, but the profits will look awesome in your brokerage account. Marko, I was taught to buy at least twice the time in the longs as what I'm selling in the shorts. You know, people go to these learn how to trade events, learn how to build a iron condor, learn how to trade a calendar, and they're taught all these certain guidelines. The guidelines don't work here, okay? This is a different approach. This is This is knowing and understanding implied volatility and time decay, and learning how to put them both in your favor based on a binary event that you know is going to happen. There's some acceptable variations of this trade, which we will talk about at length. By the way, this presentation is really, if you don't mind, for lack of a better word, it's a sales pitch for a workshop that I'm going to be putting on. It's an extensive workshop. It's going to last an entire quarter. It's going to start out with a long 3-hour Saturday training session. It's going to follow up with multiple during market hour trading/training sessions that will last an entire quarter, and we'll go through this. There's opportunities to put this trade on almost every week of the year. Okay, if you can't tell, I'm really excited about it because I've been doing it for a long time. I've taught this strategy to a lot of people, and a lot of people have told me now that this has become their favorite strategy to trade earnings, and some, just bar none, their favorite strategy to put on, compared to anything else that they've traded. So let's see. Let me show you a little bit more about how this works. Okay. Let me see. Why would you want to take a chance on an earnings date? I'm going to try to get into that. I hope I have time. How are we doing on time, Tom?
We're okay. We have another 15 minutes or so.
Okay, and I got about another hour of material. So I'll have to try to speed it up.
I had a question. Do you have any back-tested stats?
Oh, I have tons. I just have tons. I have tons. Let's do this. Let's go next a minute here over to another piece of software to illustrate just another specific trade or two. Okay, here's one on IBM that, let's see if I can find it. All right. Okay, I don't know if, I'm sure many of you are familiar with the One software. Let's see.
Yep.
Good deal. All right, so you're familiar with this screen. Let's take a look at an IBM trade. IBM from a previous quarter. IBM was, okay, let's go back another quarter to the January earnings, and we'll go to a trade initiation date. This is already loaded up. Just so that you can see what's happening here, you can see the risk graph when this trade was initiated on December 28th in anticipation of the January earnings event. This trade, the entire risk graph, looked absolutely horrible, completely underwater. If you guys are familiar with that, you know that some of the subsequent lines are, T plus various numbers, and the dark blue line is the front expiration risk graph. Okay, so let's see. We'll take this trade was done for a cost of $250, and let's take it forward. I don't want to go necessarily day by day because we got too much material to cover. Let's go week by week. Let's go December 28th, and let's go forward to January 3rd, and within 1 week, this trade is already, even though the risk graph, the expiration risk graph is well underwater, this trade sitting right in the middle is already up $50 on a $250 investment. So this was a great trade that turned into good profitability early on. They aren't all like that. A lot of them will stagger. See, did I go to a wrong date? Let's see. Maybe. Let's go to. I must be picking the wrong date here. Let's see. January 20th is when those options expire. So I got to go to. Yeah, that's not working for me. I'm not sure what I'm doing wrong. January 27th. I have no idea what I'm doing wrong. You know, I may have adjusted this trade. I may have adjusted this trade and modeled in some adjustments. Let's try another stack. Let's do Home Depot. Let's see. We'll just do one more of these, and then I'll show you some other. Let's try Home Depot on January 17th trade initiation date. HD. Okay, so there's another trade initiation date. This one done for only $95. Two calendars, a call calendar and a put calendar. You can see the strikes are 140 and 130. And we'll go forward. It didn't work real well for last time, so I'm a little nervous about going forward a week at a time. But it should work. I don't know why it wouldn't. So we're out there on January 17th. Let's go forward a week to January 24th. So again, here you can see, I'm just going to step it through quickly day by day. If my screen refreshes fast enough, this shouldn't be a problem. Is this coming through okay?
Yeah, looks good.
All right. So there you go. You got prices approaching one of the tent poles, and we're holding on to some fairly good profitability at about 23% profit against risk. And this is kind of what kind of a minimum that I shoot for is a 20% profit against risk. There's a lot more profits available. I'll show you some history quickly here. This will be our last example in this one, although I have many other examples that I could run by you. I'm not cherry picking here. I'm just picking, you know, the run-of-the-mill trades and show you an example. You know, you got to be careful not to get greedy. You got to know, you know, what are the parameters of what is a reasonable profit target to expect on this stock. Not all stocks perform equally in this particular strategy. This one's just kind of hovering around that 22. Now it just jumped to a $32 profit for a 33% profit. Personally, when I'm at my this is a location that you need to take into consideration, possibly doing an adjustment. And I will teach all about all the possible variety of adjustments in the workshop as well. So this is getting to the point where here we're at February 13th. The fronts are going to expire in just a few days. We're at one of the tent poles. Personally, I'm going to take my profits and walk away from this trade. I'm not going to adjust it. I'm not going to cross my fingers and hope that it just stays here for a few more days. I'm just when I'm this close to a tent pole or a strike, for example, in other words, and I'm this close to the fronts expiring, gamma is increasing in those fronts. I got to be careful because you can see it's a slippery slope to the downside if price keeps increasing to the upside and surpasses that the call strike. But let's walk it forward just to see what did happen. Okay, just got a couple more days, and sure enough, if you didn't take your profits there, you're giving most of them away. However, let's see, we're on February 16th, Thursday, right before expiration day. You got one last chance to take a $42 profit there, and if you didn't do it, it deteriorated down to 8 on expiration day. So again, not to be greedy, have a profit target set, and then manage the trade based on a set of parameters that I will lay out for you with all of our research. Another thing that we're going to include in the workshop is access to a PDF file. So let me talk about how that works and some of the development that goes into that. So one of the first things we do is I've already illustrated is we back test from OSBT. We do a lot of back testing as well as live testing as well as forward testing. And we catalog all that testing into a optimizer workbook that we're building, that we've built actually a couple years ago, and we continue to improve it in Excel. I might give you a glimpse of that. I think I can give you a glimpse of that. Let me see if I have it. Yeah, I do have that open. Just so you can get an idea of some of the research that we do. I've got the symbol column kind of hidden here because honestly, I just don't want to give away all of the different symbols that we've researched so hard and done so much testing on. You know, I've got people who that we need to pay for all of this research, and we have people who are paying us to do the research. So I can't really give too much away in a free webinar. I have already given you the exact strategy, exactly how to perform the strategy, so you can do that on your own. You don't need to take the class to do it. But you can see this is days. You can see obviously green is positive numbers, positive profit. These are profit percentages. There's some big numbers here. I don't know if you guys can see this on your screen. It's very small, but there are some big numbers here: 28%, 42%, 58%. 70%, there's 107% profit. Yeah, there's some losing trades, okay? But even some of these losers came back to have a 31% profit. There's opportunities even in these, when the trade starts out red, yeah, there's one that only had 9%, so that's not a great one that we're necessarily going to recommend that we trade, right? If we got stocks that don't perform well, and we have literally hundreds, as I'm scrolling through this, we have hundreds and hundreds and hundreds, okay, of the research here. And this workbook has huge optimization capabilities, as I can screen and filter based on debit, price of stock, days prior to expiration, days prior to earnings events. I can filter on many, many different levels, okay? And I'm just scrolling across here to show you all the different, I mean, I can't explain it. But anyway, I won't bore you anymore with that piece of research. Let me show you some, okay, that's one of the things we do. Let's see. So here's let me take that one off the screen and show you some more of the research that we do. And so what we do is we provide all of the results to our research to you to help guide you through this trade. So here's some download to Excel. When I showed you the OSBT, you do a back test, download the results to Excel, and catalog them. So here's JNJ as the stock, okay? Here's some information. Here's the next earnings date, 4/18. When do we put the trade on? About 5, 6 weeks, 7 weeks, somewhere in that zone. Every stock is different, but generally speaking, about 5 or 6 weeks ahead of the earnings event. Sell the week that expires ahead of the earnings event. Buy the week that expires after the earnings event. Stock was trading at 126. JNJ, boring symbol, right? I told you we trade the faint. Sure, Tesla's great. Amazon's wonderful. I love trading Google. But these other stocks, Home Depot, Johnson & Johnson, there's a ton of other stocks that you would think, yeah, Marko, don't bore me with. It's not about being excited or being bored. It's about where do I go to seek out profitable stocks that are profitable with this approach to earnings. Risking only $66 per double calendar. This is not a real high flyer here, but look at what kind of profit potential this provided in this specific event. There was an opportunity. Now, would you have stayed on that long? Personally, I probably wouldn't have. I generally have, depending on the stock, I have a profit target that I'm after, and I'm not going to hold on until the very bitter end unless the stock is behaving properly. If the stock is behaving properly, in other words, staying inside of my tent poles, then I hang on, and I teach how to manage that and how to make those decisions going forward. We'll have weekly sessions week after week. Well, actually, every other week, but for about 12 weeks, we're going to have. I'll explain the details of that. So this is all back. You see each of these tabs? These are all back tests on JNJ. And you see that last spreadsheet I just showed you? All of these tests are in there, and then they're consolidated there, and they're screened and filtered there to make sure we're comparing apples with apples. And then we create what I call the PDF file. I'll show it to you in a moment, or I'll show you a glimpse of it. So this event only turned a 13% profit on that same stock. Here's an opportunity for 50%. So we keep track of what is the maximum profit available in every specific quarter. Okay? This one, strikes were unavailable for this date. So we passed on that trade that quarter. We just passed on it. Now, I'm not suggesting that we're out here to try to capture the highest profit available in any one trading event. No, I just keep track of it, and I'll explain to you the reason, because I'll explain the reason in just a moment. So here's a 51% profit on a $47 trade. Now, of course, this is everything's based on one trade here. That's just how we do it at OSBT. Everything is based on one trade. And then if you're a 10-lot trader, multiply by 10, okay, et cetera, et cetera. So let me take you to the next. All right, so let's see. So then we take that other tool that I showed you where I can do all the filtering and screening and make sure that I'm comparing apples with apples, and then we load it into this worksheet, and this is a summary sheet of all of those trades. Okay, here's a trade that was put on 12/21/15, anticipating the earnings event of 1/26/16. Here's a trade put on 3/14/16, anticipating the earnings event of 4/19/16. And here is the maximum profit. Okay, let's start from left to right. Date of trade, price of the underlying, how much was the underlying trading for on the trade date, what was the debit, total debit for the double calendar, double eagle, what was the strike spread, how many points between the put and the call, how much distance between our tent poles, what was the maximum profit attained available sometime during that trade between entry date and front expiration date, not beyond front expiration date. I will teach you how you can morph this trade into other types of opportunities to enhance the profitability beyond the fronts expiring. So as soon as the fronts expire and they expire worthless, or you have to pay a little bit for one of them or the other, you still own your longs, and you can then morph that trade into some other strategy, whether it be, a vertical or a condor or a back ratio or a butterfly, whatever the case might be, whatever makes sense to you at the time based on your bias and your opinion. I can see I'm really quickly running out of time. So then we quickly calculate the mean and median of all of these. Okay, and under largest profit, we capture the 4 lowest profits available. What were the 4 lowest profits available out of our testing? Okay, as well as the mean and median. Then we do one more thing. We move it to another report that we make available to our traders. And this is what we call the PDF. And this is a file that's available to you as a Double Eagle workshop enrollee. This is available to you 24/7, 365 days a year, and it tells you about what stocks. Now, this is just a glimpse. This is the list of stocks that came up you can see there all these negative 2 days. That's the trade day. The recommended first day to trade this strategy on these stocks, and I have the symbols hidden again here. I apologize for that. I have them all hidden except JNJ, because JNJ came up a couple days ago as prime ripe for this strategy. Green indicates it's a confirmed date. White indicates it's an estimated date. There are some benefits to trading estimated dates. I just not going to have the time to illustrate that, but it's huge. But there's also additional risks when you take a trade on an estimated date. J&J is not one of those. J&J almost always confirms a date prior, and then we provide this for some guidance for you, some guidelines. What was the average price of all of our back testing of J&J? What is it trading for today? Well, today it's trading for 132. This was probably captured yesterday. This is live. This is live. This column is just. This is not live in the PDF. It's live every time I capture it and publish it, which is pretty much every day or every other day, depends on the season. So here's the average price of the underlying at the time. Let's see. Let me get in column 4 here, or line 4. So it was at 108. The average debit was 56. So this gives you some guidelines of, what if I model up the trade today as if I was wanting to put the trade on, how similar is today's situation compared to the back test? And can I find some correlation and some comfort zone in, yes, today's information, and if I put the trade on today, is going to be very similar to the averages that we found in our historical testing of this strategy. What is the strike spread? 6 plus or minus 1.3. Okay, so somewhere between 5 and 7 is the average strike spread of our testing. Okay, and what were the 3 or 4 lowest profits? This is how the lowest profits attainable in all of those trades was 13, 50, 51. Is it reasonable to expect a profit of 170%? Well, it happened once, but it's not really reasonable to expect that. It only happened once. Is it reasonable to expect a profit of 13%? Yeah, that happened in all 7 cases. It always reached 13%. And in most cases, it went over 50. So that's why we keep track of the lowest 3 or 4 and publish them to you so that you can say, okay, what can I reasonably expect as a profit if I put this trade on today? In percentage terms. So it doesn't matter if you're a 1-lot trader, a 10-lot trader, or a 50-lot trader. So it's done in percentage terms. All right, so let's see. I have so much more to cover, but I guess I should wrap it up here. And
yeah, we're a little over.
Yeah, understood. So let's see. Facebook. So this is the link to the course. And a little brief description. The cost of the workshop is $785. This includes approximately 12 hours of training. Begins with a 3-hour educational interactive webinar, Saturday, June 24th, about a week and a half from now. 3 hours on that Saturday, followed up Monday, the 26th, which will actually put trades on live during market hours. 6 more sessions that will last at least an hour and a half, and believe me, I always over-deliver. We'll probably have more sessions in between. Last time we did this training, we had this first, we did a Saturday, and then we went 6 Mondays in a row, and I realized quickly that there's a better way to do it. We're going to go every other Monday, and we'll probably interject a couple other quick, shorter Monday sessions in between. We'll add some sessions as we see trades need adjustment and traders need some more guidance, okay? And you get full access to the PDF file for the entire quarter. If you write that link down, I'm going to go to that link. Let's see. What did I miss this here. Guidance and guidelines.
And Marko, what's in the PDF?
The PDF. Let's see. I had it on screen. I had a view of it, which is right here. Okay, so this is the PDF. It gives you a lot of information. It shows you when to expect the press release. I didn't show you all the tools that we have. Believe me, we have a really powerful algorithm which very accurately predicts the next earnings date. And then so quickly, what's in the PDF? The most likely expected MLE, the most likely expected press release date for when the company will announce when they're going to have their next earnings date. The earnings release date, most likely expected. If it's in green, it's confirmed already. If it's white, it's not confirmed. A recent price. I've just got this generically set to 32 days ahead of front expiration but we actually are developing specific days. How many days to put this on a stock-by-stock basis. So a recommended suggested date to start considering putting the trade on. How high is my confidence level on an estimated date, and what to do if I have a low confidence level and I think that my estimated date 7/13 could go either way. I'm not going to even put that trade on. It's too risky. Okay. But if I have a recommendation, consider shorting 1 week earlier, consider long 1 week further out in time. This is based on, I'll have to explain that during the workshop because I just not enough time to explain how I come to all this recommendations
Sure.
for today. And as well as a liquidity rating, how many trade days away till the suggested trade date. Now, in the PDF will actually show you what's coming up next week and the week after, what came up last week and the week before. So it's much longer than this. It's a much longer list. Of course, in slower times, as earnings season dies down, this list gets shorter. But generally, there's something to do almost every week of the year. The average underlying of the price, and then these stats here are all from that report that came out of the prior. This is from the summary sheet, which is this summary sheet. So this is the summary sheet of all the back tests, and then it calculates mean and the lowest 4 profitability situations. All right.
Are these just available for the workshop, or do the insider members also get that?
No, only workshop attendees get it.
Okay.
Specifically for workshop. Okay, so let's see. Full access to our research and development results from behind the scenes.
And if people get the workshop, how long will they be getting that PDF?
For the entire quarter. And then it's available by subscription for, right now it's priced at $100 per quarter, but the more people that subscribe to it, the lower that cost will go. We're not trying to make money on the PDF. We're just offering it as a service to anybody who's taken the course. And right now it's at $100 per quarter. You get the first quarter free with the workshop. And then going forward, the honest truth is you don't need the PDF really any more than 1 quarter, because if you just capture it every week, all you got, or just capture it, take a screenshot of it, you'll have the information, and then you can keep the information updated yourself, honestly. But most people don't want to do that. Most people are kind of like, yeah, let Marko do the work. It's only $100 a month.
All right, a quarter.
A quarter, $100 a quarter, correct.
And Sam asked, does the workshop have a recording available after you do it?
Every session is recorded. Every session is recorded and provided to you to download to your computer so that you have it forever. So let's see. Any other questions?
Are there any discounts for insider members for the workshop?
No, there's no discounts for the workshop. This workshop is going to only go up in price as time goes on, and as we further develop our tools and the extensive follow-up sessions, etc. Let me see if I can find that. If you go to this URL, OptionSlam.com/training course, that's where you can actually sign up for the workshop if anyone is interested in it. And there's either a PayPal or your credit or debit card. Two different ways to sign up for it. Let's see. Do I have time just to read this, Tom, or do we need to wrap it up?
If you do it fast.
I'm talking as fast as I can. Double Eagle is a disciplined approach that has an inherent and distinct edge by its very design. This strategy allows for more price volatility than standard directional or delta neutral calendars. This strategy benefits from an increase in implied volatility, which we know is going to happen. There are opportunities to apply the strategy almost every week of the year. This approach provides the trader with a high probability of profit combined with an attractive risk-to-reward ratio. Requires very little monitoring and management. You might call it, in many cases, a set-it-and-forget-it trade. Check it once a day, and that's really all you have to do, unless it's starting to get close to, needing some management. But for the most part, it really is almost like a set-it-and-forget-it trade. Yes, some of them become challenging, and you have to manage them and make adjustments. But we will go through all of those details in the workshop. It's an excellent strategy for times of low implied volatility, such as we have been experiencing recently. Let's see. Start Saturday the 24th, 11 a.m. Eastern Time, 3 hours. Usually it'll go for, sorry, but that's just the way I am. I try to pack too much into a small time frame, and I just don't have enough time to cover it all. And then 6 more live during market hours training sessions that are outlined here. Immediately after the 24th is Monday the 26th, our first session. We will actually design and put on trades in that session. And then every other week, but we will probably interject a few extra short sessions on the intermediary Mondays just to help anybody who's got questions and some guidance, and especially if there's something going on. I'll know if something's going on because I trade these strategies myself. So I'll know if there's something that's going on that needs an additional webinar. So with that, I'll wrap it up. I apologize for going so far over time. Thanks for your patience. Thanks for your attention.
Thanks very much, Marko. Really appreciate it. I'll get this posted with the links, and hopefully people who are interested will join your workshop.
Awesome. Thank you again.
All right. Thanks, everyone.